So I'll start with you, Sharmin. Tech has gone through something of a roller coaster ride. It was the leading force in the markets for quite some time. Now, not quite so much. Where is tech right now in its effect on the markets overall?
It's actually a bit of a misconception that tech stocks were the driver of this entire bull market. And clients ask us that question: what happens if we don't get the kind of earnings growth and we don't get the kind of price appreciation? So we did an exercise for our clients looking at an equal weighted index and a market cap weighted index. So for example, if you're thinking about Apple and Microsoft as an example, and you're looking at stocks where the market cap weight is about 6%, Microsoft a little bit less than that, and then you look at Exxon and Coca-Cola, where one is a little bit above 1% market cap, the other one a little bit less before, and you actually gave them equal weight and looked at the returns, they're nearly identical for the last 5 years and last 10 years. So it's a bit of a myth that you need the technology sector to drive equity returns. So we're actually telling clients that at the margin, tech stocks are a little bit overvalued. It's not so overvalued that people want to take a reverse position and be short that market. But we actually think it's a little bit, 5 plus 10% overvalued, but not that significant. And we're not pricing the kind of earnings growth that people had for the last 5 years, for example, especially because of the pandemic.
So, Lori, if tech isn't the buzzword that it once was, what is? When you talk to your clients, what are they talking about today if it's not tech?
So I would say one of the more interesting discussions we have with people is sort of what's going to lead when we come out of this economic challenging period, whatever you want to call it. And there's a general agreement that the economy is going to be pretty sluggish. We're not going to be roaring in terms of growth again. And so you want growth stocks. But what are the growth stocks of the future? I think certain parts of techs, software, for example, cyber comes up a lot. I think that will give you some of those longer term secular growth tailwinds. But a lot of people are talking about industrials, reshoring, nearshoring, automation. And kind of everything is old is new again. Kind of that theme coming back. Are we going to get those growth engines from kind of these older parts of the economy that are going to get reinvigorated? And so that's probably the most interesting debate, is just kind of where do you want to be over the next 3 to 5 years in terms of some of those longer term sector drivers.
So, Sharmin, when I hear about onshoring and nearshoring, I think about geopolitics to some extent, because that's driving some of that force, I think, right now. What about the question of geopolitics for an investor these days?
One of the questions our clients are asking us actually is, given how much non-U.S. economies, non-U.S. markets have lagged the U.S., whether this is the time actually to go overweight Europe, to go overweight emerging markets, in fact, to go overweight China. And our response to that is, while on the surface it looks like these markets are very cheap. So, for example, if you look at price to forward earnings, it looks like China is trading at a 35% discount to the U.S. So everybody's so interested, given the zero COVID policy having been abandoned. But once you actually adjust for sector weight, it's nowhere near as cheap. It's maybe about 11% discount. That's not enough to take on all the geopolitical risks associated with China. So when we go through the geopolitical risks for clients, we go through first Russia, Ukraine, and you talked about that earlier in the program, and we say there's risk of escalation. We go through U.S.-China relations, risk of worsening, less likelihood of getting better. Then you go through North Korea and their ballistic missiles. So we go through these. These are tail risks, but it doesn't mean you can position your portfolio for these tail risks. You can't be out of equities, given our expected upside return, or out of bonds. So we want clients to be aware of these risks, but we actually don't recommend shifting the portfolio significantly for that purpose.
So, Lori, I'm aware that you are a U.S. equity strategist for RBC Capital Markets, but what do you think about the U.S. versus non-U.S. question?
Well, it's a great question. I got an earful about this in December. I was spending a lot of time outside of the U.S. meeting investors, and I found that European-based investors were really high on Europe. And really, for reasons you mentioned, said the U.S. is expensive, it's the growth trade, we like value, and, the U.S., we're uncertain about the fundamentals of the U.S. And I kind of pushed back and I said, well, I understand the valuation component, I said, but then it gets into what do you really want to buy? Do you really want to buy European financials? Do you really want to buy European energy companies? And they kind of, recoiled a little bit on that. But I think the issue for me as well is, even though we do have a bit of uncertainty in the U.S., I do think the fundamental backdrop is still stronger here. When we look at what companies are saying about the China reopening, I think they think it's going to be a bit more complicated than investors have been assuming so far. So I've still been in the U.S. camp, but I certainly understand, the valuation concerns people have.
Sharmin, I'm curious, do you see a certain chauvinism on the part of investors, whether they're in Europe or the United States? We tend to look close to home.
Well, there's always a bit of a domestic bias. People know the companies very well, they're more comfortable. But our view of U.S. preeminence is not actually driven by the fact that we're all based in New York. It's actually a very international group. We have colleagues all over, 23 different nationalities in the team. So there's not that domestic chauvinistic bias. It's just that if you look across metrics, and for people who are interested, we recommend looking at our Outlook presentation, the report, because we show 16 different charts where U.S. is so much more dominant and preeminent relative to other parts of the world.